Okay, let's unpack this. Today's market is a truly fascinating puzzle, isn't it? We've got major indices flirting with all-time highs, painting this picture of robustness, yet beneath that surface there's this palpable undercurrent of caution and, a significant narrative about a cooling economy that's really gaining traction. Welcome to the Deep Dive, where we don't just skim the headlines. Our mission today is to go beyond the immediate numbers of today's U.S. market midday report from September 9, 2025. It's a fantastic breakdown from bulls, bears, and the bell, and we want to truly understand the hidden drivers, the why behind what we're seeing, and perhaps most critically, the what next that's shaping current market sentiment. If you're looking to quickly get well-informed on what's truly shaping the financial world right now, maybe to cut through the noise and understand what might seem like conflicting signals, well, you've absolutely come to the right place. We're here to give you that shortcut. And let me tell you, we have some absolutely compelling themes to explore today. There's that surprising bad news is good news narrative. It sounds counterintuitive, but it's dominating discussions. We'll delve into the Federal Reserve's delicate balancing act, trying to navigate these choppy waters. Then there's the continuing AI gold rush, showing no signs of slowing down. If anything, it's speeding up. And a powerful, almost defiant resurgence in merger and acquisition activity that tells its own story about corporate confidence. It's a complex tapestry for sure, but we're going to connect all the threads for you. Our goal is ensuring you walk away with a crystal clear understanding.
What's truly fascinating here, and what bulls, bears, and the bell so deftly highlights, is how the market is processing a multitude of, nuanced information all at once. On the surface, if you simply glance at the major indices, the picture looks remarkably robust, almost serene, actually. However, the granular details embedded within this midday report tell a far more complex and compelling story. It speaks volumes about evolving investor expectations, the underlying economic shifts that are genuinely at play beneath the surface, and how different, often sophisticated, market participants are positioning themselves in anticipation of future events. We're going to be drilling into these pivotal data points, understanding how they interlace to form that larger, intricate picture, and what they truly signify for you as an informed observer. It's about discerning those crucial signals from all the accompanying noise, and today, well, there's quite a bit of both that warrants our close attention.
Okay, let's begin with the big picture then. Those headline numbers that consistently grab our attention first. And at first glance, the report makes it look pretty rosy, right? The U.S. equity markets are exhibiting what bulls, bears, and the bell characterizes as a listless but firm tone in midday trading. As of approximately 12:37 p.m. Eastern Time, the major benchmarks are all holding remarkably close to their all-time highs. The S&P 500, for instance, is up a modest 0.1% to around 6,492.75, just hovering below the record high it set last week.
Just barely below, yeah.
Right. The Dow Jones Industrial Average has gained about 0.2%, adding 106 points, trading near 45,563.1 time bay. Also approaching its historical peak, and the tech-heavy NASDAQ Composite is edging higher by about 0.1% to roughly 21,858.15 new. Nicely holding its ground after closing at a new record just yesterday. It's almost like the calm surface of a very deep pond shimmering peacefully in the sun. Everything looks still, beautiful, reflective. But as we often say here on the Deep Dive, what's truly happening underneath that deceptively calm surface, what deeper currents are at play?
Indeed, those headline indices, as you've highlighted, they paint a picture of resilience and modest gains. It reinforces a perception of a strong, perhaps even a Goldilocks market. But if we connect this to the broader picture of overall market health, the internals, as meticulously detailed in the Bulls, Bears, and the Bell report, reveal a significantly more nuanced reality. This is precisely where our deep dive gets truly interesting, because the market is never a monolith. It's a dynamic collection of many different, often competing movements. Specifically, we're seeing what's referred to as mixed market breadth. Now, what this means is that while the major indices like the S&P 500 might be registering gains, often propelled by the outsized performance of a few giant influential companies, the overall health of the market is actually less robust.
Okay, so not everything is going up.
Exactly. This is because the number of individual stocks that are declining has actually outpaced those advancing. To put it another way, it's like a few star players are scoring all the goals, driving up the team's overall score, but the rest of the players are sort of struggling to keep pace. It indicates a lack of widespread conviction or broad-based enthusiasm across the vast majority of companies. And this narrow leadership structure, well, it leaves the market vulnerable, as it relies heavily on the continued strength of just a handful of names. And then we turn our attention to the CDOE Volatility Index, or VIX, Wall Street's fear gauge.
Right, the VIX, always important.
Today, the VIX is trading around a historically subdued level of 15.2. On the surface, this generally points to a significant degree of market complacency. It suggests investors aren't currently panicking or anticipating immediate, sharp downturns.
So no fear.
Well, this apparent calm, this low VIX number, it often belies a more cautious and sophisticated institutional positioning. We uncover this when we look at the VIX futures curve, which bulls, bears, and the bell notes is currently in a state of contango.
Contango. Okay, can you break that down for us?
Sure. To explain that simply for our listeners, contango means that the futures contracts for coming months are priced progressively higher than the current spot price. Some of those future contracts are climbing above 21. Now, this specific structure is highly significant because it's not just a quiet signal, it's a strategic maneuver. It indicates that while traders might not be overly concerned about immediate shocks in the very short term, say, over the next week or two, they are nonetheless actively hedging against potential volatility later in the year.
So they're buying insurance for later.
Exactly. This forward-looking caution suggests that behind the scenes, sophisticated players are positioning for potential turbulence related to specific, known future events. It's not outright fear in the present, but a calculated defense. This implies they see the current calm as fragile, maybe susceptible to the weight of upcoming inflation data, Federal Reserve policy shifts, or even geopolitical developments, rather than a deep structural stability. Historically, periods where the VIX curve showed such pronounced contango have sometimes preceded periods of reevaluation once these anticipated future events unfolded. It reinforces the idea that the market is always anticipating, always repositioning. This tells us that beneath that calm surface, there's a definite undercurrent of strategic caution, a quiet preparation for what might lie ahead.
Wow, so beneath that placid surface, the institutional players are clearly hedging. That indicates a deep undercurrent of caution. That's a fascinating dichotomy. It feels like the market isn't truly complacent, it's strategically cautious, waiting. And that brings us to the core of what's fueling this delicate balance today, that almost paradoxical bad news is good news narrative. What's the specific piece of data that ignited this seemingly counterintuitive interpretation and has the entire market buzzing? Here's where it gets really interesting and perhaps a bit perplexing on the surface. The dominant theme today, the one that everyone from individual investors to institutional strategists is talking about, is that bad news is good news narrative. It sounds incredibly counterintuitive, doesn't it? How can something negative for the economy possibly be a positive for the stock market?
It does seem odd at first glance.
But the core of it stems from a pretty significant, indeed I'd say pivotal, piece of economic data released this morning. The primary catalyst for today's market sentiment, as our bulls, bears, and the bell report highlights, was the Bureau of Labor Statistics' preliminary annual revision to employment data. And it proved to be quite impactful. The report revealed that the U.S. economy added a staggering 911,000 fewer jobs in the 12 months through March 2025 than was previously reported.
900,000, that's huge.
It is. That's a substantial revision, representing a 0.6% reduction in the total workforce estimate. What it effectively means is that job creation during that period was only about half of what was initially believed. That's not a minor tweak or a statistical blip. It fundamentally changes how we view the job market's trajectory over the past year. From your perspective, how significant is this kind of revision, and why has the market reacted with such, well, relative optimism?
This raises an important, almost counterintuitive question for you listening. Why does less job growth, which on the face of it seems like genuinely negative economic news, actually get interpreted as unequivocally good news for the stock market? It's a fascinating paradox rooted deeply in the market's relationship with the Federal Reserve.
The Fed connection.
Exactly. The consensus among traders is that this revised data is definitive, irrefutable proof of a cooling labor market, a slowdown that the Fed has been explicitly seeking to tame inflation. Think back to their rhetoric over the past year. Every strong jobs report was a headache for them, suggesting inflation could remain sticky and forcing them to maintain a hawkish stance. So this revision isn't just a number, it's the market handing the Fed a golden ticket, a pretext to finally shift its policy stance.
The justification they needed.
Precisely. For a market that has been yearning for easier monetary conditions, particularly through interest rate cuts, this is exactly the signal it needed. It validates the soft landing narrative, the idea that the economy can slow down enough to cool inflation without tipping into a deep recession, and crucially, without the Fed having to keep interest rates restrictively high for longer. This rapid shift from inflation panic to rate cut euphoria is more than just logical deduction. It's a classic example of market psychology at play, where the collective sentiment can pivot dramatically based on a single data point, often discounting other underlying factors. Historically, these Goldilocks interpretations, while initially boosting markets, have sometimes preceded periods of reevaluation once the full economic picture emerges. It's a peculiar dance between Main Street and Wall Street, isn't it? Furthermore, this pivotal data point of a cooling labor market is corroborated by other significant evidence of a broader economic slowdown. The latest NFIB Small Business Optimism Index, for example, while showing a slight rise in overall optimism for entrepreneurs. It also reported that hiring plans remain historically low among small businesses.
Okay, so less hiring planned by small businesses too.
Right. This suggests that the engine of job creation at the grassroots level isn't firing on all cylinders. And perhaps even more significantly, the net percentage of owners raising selling prices fell to its lowest level of the year.
A disinflationary signal.
A crucial disinflationary signal that strongly supports the case for a rate cut, alleviating some of the Fed's concerns about persistent inflation. So you have both a clear slowdown in jobs, now officially revised downwards, and a moderation in price increases at the small business level, all pointing in the same direction, giving the Fed a very clear pathway to act. The market's reaction to this jobs revision was immediate and decisive. It solidified expectations for a September rate cut. According to the CME FedWatch tool, which is widely used by traders to track Fed funds futures probabilities, expectations now stand at approximately 90% for a 25 basis point reduction. That's a quarter of a percentage point, or go 0.25% at the conclusion of the Federal Open Market Committee meeting on September 17th.
90%. That's very high conviction.
It is. There was even around a 10% chance for a more aggressive 50 basis point cut immediately after the release, though Bulls, Bears, and the Bell notes that some of those more aggressive bets pared back a bit as traders digested the nuances. This outlook is shaping commentary from strategists, too. Brian Jacobson of Annex Wealth Management, for instance, he's suggesting that the Fed may prefer a series of more measured cuts in October and December, rather than a single large catch-up cut this month.
Spreading it out a bit.
Exactly. This approach would allow them to observe more data before committing to larger moves, while still signaling their intent to ease policy. It's like they're trying to land a jumbo jet on a dime, a delicate operation with very little room for error.
That's a compelling interpretation.
Yeah.
It's almost a market-wide sigh of relief, saying, okay, Fed, you've got your justification, now make the move. But I have to ask, isn't there a risk here? Is the market potentially overinterpreting this one data point? What if this jobs revision, while significant, also hints at a deeper, more concerning fragility in the labor market that goes beyond a simple cooling, potentially impacting future consumer spending and ultimately corporate earnings? Is a market perhaps too eager to embrace this narrative without considering potential downsides? Is this calm really here to stay, or is it maybe a temporary lull before the next wave of data hits?
That's a crucial, astute point, and the calm we're observing is most definitely tentative. The market is forward-looking, but sometimes it extrapolates a bit too aggressively from a single piece of news. This naturally leads us to ask, what's the next hurdle the market needs to clear, and what could truly disrupt this cautious optimism? Because the entire market narrative right now, and especially this bad news is good news dynamic, it hinges precariously on upcoming inflation data.
Oh, inflation. The elephant in the room.
Always. Bulls, Bears, and the Bell highlights two critical reports later this week. The Producer Price Index, or PPI, which gauges wholesale inflation, coming out on Wednesday. And then the all-important Consumer Price Index, or CPI, which measures retail inflation, due on Thursday. These reports will either validate the current market's optimism for rate cuts or, well, throw a significant wrench into the works, potentially forcing a rapid repricing. If we get hotter than expected readings from either of these inflation reports, that could quickly unravel the current bullish sentiment. It would challenge the Fed's newfound justification for cutting rates. Imagine if core CPI, which strips out volatile food and energy prices, comes in higher than expectations at, say, 0.4% month over month.
Oof, yeah. That wouldn't fit the narrative.
Not at all. That would be a serious jolt. It would create a worst-case scenario for the Federal Reserve, as our report implies. They would be forced to choose between supporting a weakening labor market, which the revised jobs data clearly shows, and fulfilling their primary dual mandate to ensure price stability. That's a very difficult tightrope to walk.
Stuck between a rock and a hard place.
Precisely. Both a stubbornly high inflation figure and a weakening job market present significant policy challenges. Conversely, if CPI and PPI come in softer than expected, it could solidify the market's conviction even further. It might push those rate cut probabilities closer to 100% and perhaps even prompt more aggressive bets on the pace of future cuts. Understanding these upcoming reports is absolutely key to knowing whether this current optimism is sustainable or if it's potentially a house of cards waiting for the next data point to fall. You'll definitely want to keep a very close eye on those numbers later this week, as they will likely define the immediate direction.
Okay, so while those macroeconomic currents, like the revised jobs data and the Fed's looming decisions, undeniably set the stage for market sentiment, the real-time drama of the market is also playing out in fascinating ways at the individual company and sector level. And it's here, amidst these micro-trends, that we see some truly strategic moves offering a powerful counter-narrative to some of that cooling data we just discussed. In particular, the AI gold rush, it shows no signs of slowing down. In fact, it seems to be accelerating with truly enormous capital commitments. Our Bulls, Bears, and the Bell report highlights several fascinating developments today that underscore this immense build-out. Take Nebius Group, for example, ticker NBIS. Their shares skyrocketed more than 40% after they announced a landmark contract with Microsoft, ticker MSFT. Over 40%, that's a huge move. Incredible, right? This isn't just a handshake deal. It's a colossal commitment, potentially worth between $17.4 billion and $19.4 billion through 2031 for the delivery of GPU services. Billions with a B for GPUs. Exactly. This kind of capital commitment absolutely validates the immense scale of the AI infrastructure build-out we're witnessing. It's not just about software, it's about the fundamental rewiring of our economic infrastructure. When Nebius Group secures a deal of this magnitude, it signals a massive reallocation of capital towards compute power as the new essential commodity. It reflects a paradigm shift where companies are investing billions, not just in applications, but in the very picks and shovels of the AI revolution.
That's a good analogy.
This creates a powerful economic multiplier effect across the entire supply chain, from specialized cloud providers like Nebius to semiconductor manufacturers. Then there's CoreWeave, CRWV, another rapidly growing AI cloud computing provider. Their shares climbed nearly 10% following a Wall Street Journal report that the firm is launching CoreWeave Ventures.
Interesting move.
It is. This is incredibly significant because this new venture arm will not only invest in, but also provide crucial compute resources, that's GPU capacity, to promising AI startups.
So funding and the hardware.
Exactly. What this signals is a new, more integrated phase in the AI ecosystem. Successful infrastructure players like CoreWeave are evolving into key capital allocators, essentially becoming kingmakers within the broader AI ecosystem. They're fostering the next generation of AI applications by providing both funding and the essential processing power. And let's not forget Broadcom, AVGO, the semiconductor giant, which is extending its multi-day rally.
Still running hot.
Yeah, this momentum comes directly from its strong quarterly earnings report last week, which was fueled by surging demand for its custom AI chips, and a reported $10 billion order from a major new client.
$10 billion more, the numbers are just staggering.
They really are. All of this underscores the sustained strength in the foundational semiconductor layer of the AI revolution. So if you thought AI was just a buzzword, these numbers show the real, tangible investments pouring into its infrastructure. It signals that this isn't just hype. It's a fundamental and accelerating shift. We're talking about a CapEx cycle unlike almost anything we've seen since the dot-com boom, maybe, but with far more tangible and immediate revenue streams and strategic imperatives this time around.
And providing a strong counter-narrative to some of that cooling macroeconomic data we just discussed. We're seeing robust corporate confidence demonstrated through a significant resurgence in M&A activity. This raises a crucial question. What do these deals truly tell us about broader corporate strategy and long-term outlooks, especially when the immediate economic picture is still a bit uncertain? Bulls, Bears, and the Bell points to two very notable transactions today that are illustrative of these trends. First, biotechnology firm Tourmaline Bio, TRML. It emerged as the day's top performer, seeing its shares skyrocket after agreeing to be acquired by pharmaceutical giant Novartis, NVS, for approximately $1.4 billion in cash.
Big premium there, clearly.
A very big premium. This deal highlights a renewed and aggressive appetite for strategic acquisitions, specifically in the biotech sector. Large players like Novartis are actively seeking to bolster their drug pipelines and secure future growth by acquiring promising early or mid-stage assets. In a world where drug development is incredibly expensive and risky, acquiring proven innovation is often a faster, more cost-effective path to market. This isn't just about a good price, it's about securing future intellectual property and market share. Second, shares of Canadian miner Teck Resources, Teck, surged over 12% on news of a merger with Anglo American plc.
Another big resource deal.
Yes, and this transaction is poised to create one of the world's largest copper producers. What's truly fascinating about this is that it represents a highly strategic move to consolidate control over a metal that is absolutely critical for the global energy transition and the burgeoning electrification trends we're seeing worldwide.
Copper, essential for EVs, grids, everything.
Foundational. Everything from electric vehicles and charging infrastructure to renewable energy grids and advanced electronics relies heavily on copper. These companies aren't just looking at the next quarter's profits, they're essentially placing multi-billion-dollar bets on the next decade. They're consolidating control over critical resources and intellectual property that will define the next wave of global economic transformation. These M&A deals, like Novartis acquiring Tourmaline Bio or Teck merging with Anglo American, are far more than just headline-grabbing valuations. They are a powerful counter-narrative to the macroeconomic caution we've been discussing. They signal a robust underlying corporate confidence in their long-term growth prospects, even in an environment clouded by interest rate uncertainty. It's an assertion of conviction, demonstrating that the C-suite is taking a much longer, more optimistic view of where the world is heading.
These aren't just big numbers, they're genuinely big strategic moves. They signal deep, long-term bets by these companies, even in the face of current economic uncertainties. It's clear they're looking far beyond the immediate horizon. And speaking of significant corporate impact, let's keep an eye on some corporate bellwethers. These are the companies whose individual movements often tell us a lot about broader consumer trends and enterprise spending, giving us a crucial pulse on different vital segments of the economy. Apple, AAPL, is a prime example of such a bellwether. The market is holding its breath today for Apple's highly anticipated product launch event later this afternoon.
The iPhone event. Always a market mover.
Absolutely. The stock has been trading flat to slightly down ahead of the announcement, as investors await details on new features, pricing, and crucially, any potential AI integrations for the new, thinner iPhone 17 expected to be unveiled.
The AI angle is key this year.
Definitely. This isn't just about a new gadget. A successful launch and compelling new features, especially in AI, could catalyze the next major consumer upgrade cycle. This would affect not just millions of individual users, but billions in revenue. And it could ripple through the entire consumer electronics supply chain and the broader discretionary spending landscape. It's a massive driver of consumer tech sentiment. And then there's Oracle, ORCL. Shares of Oracle are up modestly as the company prepares to report its quarterly earnings after the market closed today.
Oracle earnings after the bell, another important one.
Right. Analyst and investor focus will be squarely on the performance of its cloud division, specifically its Gen 2 cloud infrastructure. And significantly, any updates regarding its critical data center partnership with OpenAI.
That OpenAI partnership is crucial for their cloud narrative.
Hugely important. The results of this report will serve as a key barometer for the health of enterprise technology spending. It gives us an immediate insight into how businesses are investing in their own digital transformations and their adoption of AI solutions. A strong showing from Oracle would suggest continued robust spending by corporations on critical infrastructure and software. A positive signal for the broader enterprise tech sector. These two companies alone, Apple and Oracle, give us a crucial glimpse into both consumer tech trends and the engine room of enterprise AI. Their news today will certainly ripple through the market, influencing perception far beyond just their own shares. Beyond the sector-level stories and the broader macroeconomic narratives, some individual stocks are having truly dramatic days, for better or worse. Our Bulls, Bears, and the Bell report provides us with clear tales for midday top gainers and midday top losers, which always offered a snapshot of where the most intense action is happening. Looking at the top gainers, we see names we've already discussed, like TRML, Tourmaline Bio, which is clearly soaring due to its acquisition by Novartis.
That M&A pop.
Definitely. NBIS, Nebius Group, is another big winner, propelled by that massive Microsoft GPU services deal. And Teck Resources, is surging because of its merger news with Anglo American. CoreWeave, CRWV, is also prominently on the list, benefiting from the launch of CoreWeave Ventures. Interestingly, United Health Group, UNH, also made the list, which we can connect to the positive guidance mentioned in the healthcare sector analysis,
Right, tying it back.
showing how sector-wide strength can lift individual leaders. These companies are seeing their fortunes dramatically shift on very specific positive news.
And that leads us to the other side of the coin, the day's top losers. The The bulls, bears, and the bell report also lists several companies experiencing significant declines today. Names like PayCS, CNM, SOC, ONDS, and ALB. Now, while our immediate report doesn't detail the specific catalysts for each of these declines, understanding the general patterns is crucial for a deep dive. Often, these dramatic downward moves stem from unexpected negative corporate guidance, perhaps a warning about future earnings that fell far below analyst expectations.
A guidance miss, yeah. That can hurt.
Big time. It could be a missed earnings consensus by a wide margin, signaling a slowdown in revenue or profitability. Or perhaps a significant regulatory hurdle has emerged, or a key product approval was delayed, impacting future revenue streams. For instance, without knowing the specific context for a stock like PayCS today, one might consider if it's operating in a highly competitive market where a competitor's win can translate directly into another's loss. Or maybe it faced a sudden, unexpected analyst downgrade that triggered a sell-off. These individual company-specific events underscore that even on a relatively quiet market day where the major indices are only moving slightly, there's always a flurry of intense individual activity under the surface for specific companies, driven by their unique stories and catalysts. It really makes it imperative to look beyond just the headlines.
It just goes to show you, yeah, even on a quiet day overall, there's always a flurry of intense activity under the surface for specific companies, driven by their unique stories, and these dramatic moves can have real implications for individual portfolios.
Now, let's connect these individual stories and company-specific moves back to the broader market, specifically looking at the S&P 500 sectors. The performance across the 11 S&P 500 sectors today reveals a market being pulled in different directions by powerful, often theme-specific narratives, rather than a unified macro trend. This actually helps reinforce that initial lack of broad-based conviction we discussed earlier.
Right, mixed breath.
Exactly. Where the headline indices were up, but market breadth was mixed, a few powerful stories driving performance, while others lag. Looking at the leading sectors, we see that information technology, often tracked by sector-specific ETFs like XLK, and communication services are both showing significant strength.
The AI effect again.
Absolutely. These sectors are clearly propelled by the ongoing enthusiasm for artificial intelligence, building on the stories we just heard about Nibius Group, CoreWeave, and Broadcom. The AI theme continues to be an undeniable force, drawing in significant capital. The healthcare sector, represented by XLV, is also a notable outperformer. This buoyancy is directly linked to positive guidance from industry giant United Health Group, which we saw on the top gainers list, and further boosted by M&A activity in the biotech space, exemplified by the Tourmaline Bio acquisition by Novartis. So there's clear sector leadership driven by innovation, strategic consolidation, and maybe a defensive quality that still holds appeal in uncertain times. On the other hand, we have some lagging sectors. The utilities sector, XLU, which was already weak in the previous session, it may continue to lag today.
Utilities down, anticipating rate cuts.
That's the classic rotation. As investors anticipate lower interest rates, they consequently rotate away from these typically defensive assets, which become less attractive when safer bond yields are expected to fall. This rotation away from utilities, traditionally seen as defensive safe havens during uncertainty, is a strong signal of shifting investor sentiment. It suggests that market participants are becoming more comfortable taking on risk in anticipation of economic growth and lower borrowing costs. They're moving capital towards cyclical or growth-oriented sectors.
So a risk-on rotation, essentially.
It leans that way, yes. This isn't just a simple shift. It often reflects a broader repositioning for a different economic regime, where capital appreciation is favored over steady dividend yields. For long-term investors, this might signal a need to reevaluate portfolio allocations away from overly defensive postures. The performance of financials, XLF, and energy, XLE, meanwhile, remains quite mixed. These sectors are particularly sensitive to broader macroeconomic forces, financials reacting to moves in treasury yields and the shape of the yield curve, and energy, of course, sensitive to crude oil prices and geopolitical developments. Their direction can shift quickly based on incoming data or global news.
It's like different parts of the economy are marching to different drums. Some are really picking up speed, riding the wave of AI innovation or strategic M&A, while others are pausing or even retreating as investors anticipate changes in interest rates or respond to commodity price fluctuations. It creates a very dynamic, almost fragmented picture of the market as we head towards the close. So as we approach the final hour of trading, what are the critical factors you'll be watching for that could shift market's trajectory and define today's session?
Looking ahead to the final hours of trading, as detailed in Bulls, Bears, and the Bell, There are several key factors poised to influence whether the market consolidates its modest gains or makes a more decisive move before the closing bell. The most significant potential catalyst for the afternoon session is undoubtedly the market's real-time reaction to Apple's product announcements.
The Apple event looms large.
It really does. As one of the largest constituents of the major indices, the S&P 500, the Dow, the Nasdaq, any substantial move in Apple stock following their highly anticipated event could have an outsized impact on the broader market's direction into the close. If the new iPhone 17 or its AI integrations are perceived as a major hit, signaling a strong upgrade cycle, we could see a late-day surge. Conversely, if the announcements disappoint, a significant downward move in Apple could weigh heavily on the broader market, particularly the tech-heavy Nasdaq. Second, in the final hour of trading, expect increased positioning and potential volatility in Oracle, ORCL, and the broader enterprise software space as traders prepare for its earnings release after the bell.
Positioning ahead of Oracle's numbers.
Exactly. The results of Oracle's cloud division and any updates regarding its critical data center partnership with OpenAI will set the tone for a key part of the tech sector heading into Wednesday's session. It could potentially influence sentiment for other enterprise tech players. A strong earnings beat or a positive outlook could provide a late boost to the tech sector, while a miss could dampen spirits. Finally, traders will be closely watching key technical levels for the S&P 500.
Watching the charts?
Always. A close above the psychological 6,500 mark would be viewed as a bullish signal, potentially indicating continued upward momentum and providing a psychological lift. Conversely, a failure to hold the day's modest gains, perhaps slipping below a key support level, could suggest investor exhaustion near these record highs, potentially setting up for a softer open tomorrow. Given the low volume and mixed market breadth observed so far today, bulls, bears, and the bell suggest the most likely scenario for the remainder of the afternoon is a quiet consolidation.
Just drift into the close.
That's the base case. However, that Apple event serves as a unique volatility hinge. It has the very real potential to catalyze a significant directional move in the final hour of trading. As the market digests the implications of the new iPhone lineup for the upcoming sales cycle, it's a classic example of event-driven volatility, where one company's news can shift the entire market's trajectory.
So don't write off the afternoon yet. That Apple event could truly be the wild card that defines the close, impacting your portfolio and the broader market sentiment, even if the overall trading volume stays light. We've taken a real deep dive into today's midday market pulse, dissecting the bulls, bears, and the bell report. From the paradox of bad news is good news to the specific companies shaping tomorrow's economy, it's been a journey of understanding how seemingly disparate pieces of information truly connect, giving us a comprehensive picture of September 9, 2025. We've seen conflicting signals from the market's calm surface versus its cautious internals, a strong anticipation of Fed action driven by that revised jobs data, and clear dynamism in sector-specific trends like AI and M&A.
If we connect all these threads to the bigger picture, it truly underscores the importance of looking beyond just the headlines and those initial numbers. The market is a complex, adaptive system, constantly repricing based on new information and subtle shifts in sentiment. And our job, as informed observers, is to discern the signals from all the noise. This raises an important question for you, our listener, to consider as you digest all these insights. Think back to the VIX contango curve we discussed, that subtle, quiet hedging against future volatility. What does it truly suggest about the inherent long-term stability of this market's current record highs, especially given the critical inflation data we have coming later this week? Are investors truly complacent, as the low VIX might suggest on the surface, or are they quietly, strategically preparing for potential turbulence even as they celebrate new records today? It's a fascinating tension, isn't it?
A truly fascinating thought to mull over as you digest all these insights. Thank you for joining us on this deep dive into today's market. We hope you're now feeling a lot more informed and ready to navigate these complex waters with a clearer understanding of what's really happening beneath the surface. Keep those critical thinking caps on. We'll catch you next time for another deep dive.